Welcome everyone to today's tutorial recording, which is part of the Water Use Efficiency Project. This project is delivered by Pinion Advisory on behalf of the Tas Farm Innovation Hub, and it's funded by the Australian Government's Future Drought Fund. The goal of this project is to improve the confidence, knowledge, and practical skills of Tasmanian farmers to support them to optimise water use on Tasmanian farms. Underpinning the use of efficient water use on farms is often financial decisions. And for today's tutorial, we're joined by James Hillcoat, who's the manager of Pinion's Farm Business Management team. Welcome, James.
Thanks, Joe, and hi to all of you who are watching this.
So, James, today you're going to lead us through some tools which have that financial decision-making emphasis behind them.
Yeah, absolutely, Joe. One of the big things with in thinking about irrigation is it's quite a big change with the capital costs required, but also the changes to the farming system that we are going to want to take into account. And these things are from a 20+ year time frame, so they take a bit of consideration. And that's what we'll lead through today, and working through from the whole of business thinking that needs to go with that, and then providing you with some tools and thought processes that you can deploy when thinking about your own irrigation system.
Fantastic. All right, over to you. Thanks for today.
Thanks, Joe. So we're going to break this into a three-part series. So part one will be focused on the cost of production being the focus to long-term profitability. So taking cost of production focus and ensuring that we can grow product for the most efficient dollars per tonne or per DSE, whatever it may be that relates to your system, and having that focus to long-term profitability when making capital decisions is a key focus. The next part of that will be then assessing some of the implications with irrigation and perhaps investment in irrigation, and just stepping the process back, being critical, being curious around the implications, some of the benefits and perhaps some of the costs that are going to come with that. And so being able to balance that out with a change in farming system or a change in enterprise choice, and being able to assess the need and options that you have available to you. Then part three of this three-part process will be, can we then justify it? So giving you some tools and insights into working out the cost of ownership and returns, plus some other considerations that we might want to take into account. So today,
James, just jump in, James. Quick question. So for those that are watching this series today, you're sitting in South Australia, obviously in different environments than we have here in Tasmania. But a lot of the things you work with your clients and with your farmer groups in SA apply equally to what we're seeing here in Tassie.
Absolutely, Joe. And I think in many ways, when we're talking about irrigation, and we're talking about more complex systems as well. So it doesn't really matter about where we're geographically located or the enterprise choices that we deploy. There is some really consistent messages nationally that we have to get right to be a high performance farm. And that's what I'm really going to take you through to start with, is sharing some observations around what we're seeing in wider industry and using some grains industry examples for this, but it'll be equally applicable across a wide range of situations. So if we take the holistic view going forward around the cost of production and the impact of capital decision making, we've got to have a focus on profitability and resilience. Our observations, this is from a national data set we're collaborators with, in this case for GRDC, and it's around the grains industry. But through the southern region, what we really need to observe is that margins are quite tight in farming. We've had a couple of years of it being quite prosperous in many locations, but again, that won't apply to every single industry. The red meat industry in the last couple of years has certainly gone through some challenges with market price, market volatility, and then we've also experienced drought through the southeastern region of Australia. So there are a number of factors that will play through affecting margin. So having a focus on how we maximize margin is a really important aspect here. Our work and observations with top 20% farmers and the insights that that can provide us is really important to being able to bolster the remainder of the industry as well, and saying, well, what levers are being pulled at this end of ag that can positively impact the rest? So in those businesses, we will typically see them retaining more profit as a percentage of income. They have a lower cost of production per ton or per DSE, which is then allowing them to be more profitable when seasonal conditions allow, but also being more resilient when seasonal conditions are more adverse. And some of the really empowering messages that we've seen come from that across a long run period of data with a robust data set nationally is that these top 20% performances and key traits are happening irrespective of geographic location. They're also not dependent on a particular enterprise choice alone. So it's really important when we're talking about irrigation that we're not saying it's going to be all the make all and break all of what we do. So we want to be taking that objective view on what we're doing and how a potential change will play into that. It's also not dependent on scale as well. So we can often think to scale being a primary driver of higher performance farms, but the correlation with that is actually really quite low. So there's three really empowering messages within this in terms of what's driving these high performance farms and the sort of thinking that we want to take in when we're making big capital decisions and big enterprise decisions when we're considering irrigation. I think it's also worth showing that the costs of farming have increased, and this is a 5-year chart across some reasonable data for the southeastern region. And we can see that, let's not get hung up on the dollars per hectare. It's actually the trends that we want to pull out here. And the increases in variable costs of direct expenses in fertilizer, chemical usage, fuel, they've all accelerated in the last 10 years. Depreciation and capital items have continued to grow in that time. And so ensuring that we're making the right decisions with these that are right for our individual business and not getting caught up in what may be happening with a neighbour's place or in another region, we've got to be very, very careful. Also balancing overhead costs. So, if we're making a decision, is it going to spread overheads or is it actually going to inflate them? So we want to be thinking about some of the flow-ons that will come from this. And then obviously the costs of interest across that time have changed. So we also want to be bearing that in mind when we're considering projects that could be multiple hundreds of thousands of dollars. Now, this is just some insights from a more regional level, looking at how the top 20% are able to continue to demonstrate lower levels of cost of production. So the average in this particular region was needing $350 per tonne to break even on wheat. Whereas the top 20% needed 260. And again, there was a negligible difference in scale in this particular region. So again, it really reinforces this very key thing we want to put in before we even start talking irrigation numbers, and that's this profit driver framework. And it has continued to prove itself across a number of years, a number of different circumstances where to create a higher performance business, retaining better profit, lower costs of production, more resilient to market and seasonal conditions, these businesses are optimizing their gross margin by creating the most amount of income that we can, but we also want to be doing it cost effectively so that we're not over-investing for higher yields and eroding margin through over fertilization or whatever it may be, or over-investment in direct cost. We also want to be thinking about low-cost business model. So what are our efficient uses of limited resources? And that's really where capital expenditure items come in. So where we're considering debt-funded things, we want to be careful about our balance and the impact that has on finance costs. We also want to be careful about the impact it has on inflating overhead cost models and ensuring we're actually getting the most amount of leverage from it and we're not injecting more complexity that it ends up eroding what we're actually fundamentally really good at. So people and management, and particularly the management part, is the glue to ensuring we've got a high performance business and can bring those two together to create the best outcome. This is why multi-enterprise businesses have to be really, really careful that we don't end up creating lots and lots of activity, but then eroding profitability from what is essentially a very stretched resource base. And this is particularly true where we've got lots of different crop options like we would in Tassie. And we've also got different options with water that we actually don't have in South Australia to the same extent. But it's equally true in a mixed enterprise dryland condition to a multi-enterprise dry and irrigated setting. We must be careful that we don't stretch our people and management that ends up eroding our gross margin optimization ability and then duplicating capital to be able to get stuff done. Joe, what's your insights with some of the diversity you might see there and the impact that might have on performance?
Yeah, James, I think the introduction of irrigation schemes over the last few years in Tasmania has really seen land use changes rolling out in different regions. And as you just said then, people being introduced to opportunities of different crops or even livestock enterprises which haven't been possible in the past. So yeah, large growth in the variability of what's being farmed, and still even greater opportunities on the horizon for the next few years.
Absolutely. Thanks, Joe. So a consultant's role is really to help step through some of these decisions. And it can be done at any level as long as we're considering these changes. So that any changes we make, we don't want to create it in lots and lots of rigorous frameworks and bogged down decision making. But when it's a big change like this, depth of thinking and assessing that project for its contribution is a really important step. So perhaps stepping that out with others, be it internal to your business or external to your business, is well worth getting this framework that we've got here and just doing a bit of a double check so that we're not eroding margin or duplicating cost and creating unnecessary complexities like we've discussed before that only injects risk. And diversification not necessarily being the silver bullet. So some of the things we might want to consider when making a capital project decision is really around its financial viability. So what are its gross margins? What are the changes in that? And that's something we'll take you through in stage 2. And then assessing what are some of the capital requirements that go with this. What are some of the additional machinery aspects? What are some of the infrastructure aspects? Or what are some of the startup input needs? So if we're having quite a big change in area, for instance, then one of the startup input needs is actually more working capital, and we've got to navigate that through. We want to think about cash flow timing as well. Market prices and trends. So the last thing we want to do is invest in infrastructure and invest in enterprises that we actually don't have a viable market for. So market first, infrastructure second is as true today as it has been going back. So really having a rigorous view on market and ensuring we've got a good pathway to product. And then we also want to think about some of the return on investment. So, an easy benchmark is, will it meet a cost of capital if we're getting money at sort of 5 to 6% interest at the moment? Well, economically, we're going to want at least that. But if we want it to contribute more to profit, well, our hurdle rate's going to be higher than that. And we'll take you through how we might assess that. We then want to look at the land and resource suitability as well. So is this enterprise actually suited to your environment? So it's an easy trap to look at some of the costs per ton or some in vogue products at the moment, or enterprises that are sort of driving growth in one area. But if we really come back to some of those drivers of high performance farms, and the one big myth there being that it's not dependent on a particular enterprise choice, we've really got to assess that it's going to have the best margin for your particular environment, and it's not just driven by price. We want to be thinking margin boundedness. What's the compatibility between enterprises? Do we have water access, and what's our usage requirements going to be? Does it actually fit with our entitlement? What's our land capability, erosion risk? Do we have storage for peak flows? Are we able to bridge gaps in sort of when our irrigation's running at peak timing if we're not on a scheme? Labour and lifestyle fit is also another really key consideration. So we've got limited resources. We have to control overheads. And what that means is that we're running at a fairly, most of the time, a fairly skinny workforce when we consider all the things that we have to do. And the impact that has on fatigue, well-being, family time, and all the other personal goals that come with it is a really key consideration that you need to make as a family or a business. To look at, does it line up with labour demand? What are the peak workloads looking like? How does that then impact with other things? So one of the big things I noticed with being a consultant is that if we've had a very intense hay period and then we go straight into harvest, and then we might be going into some sort of perhaps calving or something like that, we're not getting a lot of downtime, and that does play through into some level of burnout.
James,
So many other things.
Probably a good point just to flag that throughout other parts of the water use efficiency project, some of the considerations that you've just mentioned there's some supporting information available. So looking in the other modules, there's information to help people have some conversations perhaps with advisors or within their business structure around identifying the viability of an irrigation design process, considering things like the natural resources, the financial viability, and the operational readiness.
That's great, Jo, and really good to have those resources behind. And so it's nice that it's validated there too, and nice to know that those resources exist. Very true. To continue the framework of sort of decision making and some of the things we might want to consider as well. Skills and experience is another one. If we are changing enterprises, particularly to quite intensive crops, do we have the skill set management to back that up? Are there training requirements that we might need? And what's the cost of making these mistakes and not putting mitigation in place? We've spoken about market access and demand and actually having the market there, but what's our proximity to the market? Do we have supply chain support in that, particularly with things like potatoes? We've got sort of pathways to processors there. Do we have the relationship with the processors to start with? So I think maintaining relationships with your customer is a really important one to ensure that if there's ever a problem, it can be easily communicated. And then what do we think some of the market trends are? Do we think we're in a growing industry, a steady one, or is it sort of in decline at the moment? Do we need to make a long-term change, or would it be a short-term reaction? And then some of the risk factors, we also want to look at sensitivity. So we can have our gross margins all nice and set, but if we've got lots and lots of volatility, big upside and downside swings, how does that end up playing? And if we did experience a downside swing, how dramatic would it be? And would we be at too much risk in that scenario? So it's certainly something we want to think about. Do we have biosecurity protocols in place? Enterprise diversification, we've spoken about it, but does it spread or increase your total farm risk? It's definitely an important consideration. And then we also want to think about its fit within your current business and core skill set. So to sort of start rounding this off and the frameworks we want to put in place, some of the metrics that we're going to want to think about are, does the business have equity and borrowing capacity? So does it match the risk appetite of your business? So we might be looking at these capital investment items, but let's assume you've already bought some land and we're still embedding that in. We've taken a bit of a bite off and equity levels are running a little bit lower. What that's suggesting is that your business risk appetite is at the lower end of things. So it may need to consolidate before we do these things, or you are going to want a better hurdle rate of return with this investment in irrigation. We also then want to look at the impact on serviceability. So equity is one thing, borrowing capacity from the bank's point of view is important, but serviceability is crucial. So equity levels have increased because of land price appreciation over time. But if our productivity line remains fairly stable, then our serviceability won't be as high on that new equity level or asset level as what it might have been 5 or 10 years ago. So ensuring that any change here with the associated increases in finance costs and additional debt, we want to make sure that we've still got the serviceability to support that and a comfortable finance coverage ratio. We then want to look at the rate of return and ensuring that it's going to be sound against what your expectations for a project would be and whether or not it's acceptable enough to you to just where at the cost of capital, we've got land prices here in South Australia that are, they are going to be less than the cost of capital. So we're taking a long-term play with some of that, but it's not going to work for every business. And then obviously we've got to think about cash flow, the impact on that, what we need in terms of overall funding requirements, and the ability to sustain that and pay that working capital back over time. So a good rule of thumb for these investment projects in capital is looking for projects that can deliver rates of return for greater than 15% and a payback period of less than 7 years. So that may not exist on things like land in every area, but when we're looking at capital items, there's certainly some guides there to that can be achieved. And there are these pockets within that may not be around necessarily making the farm size bigger, but what can we do with that internal capacity and look for projects that can do something like this. And what I say to clients as well is adopt an entrepreneur mindset first. Always take on an opportunity, look at it. If it's not the right fit, we can then discount it, but never let an opportunity go home without doing some homework first. But on the flip side of that, we also want to be careful that we're aware of our own internal bias, particularly confirmation bias in this particular instance. So if we think it's a whiz-bang thing, we are naturally going to want to find things that support that view. So having a little devil's advocate on your shoulder that's sort of screaming confirmation bias at you might enable a little bit of balance to go, let's seek another opinion, let's seek some additional information that perhaps counters some of that view and make sure that we're not getting wrapped up in the hype of whatever we might be thinking about. So Joe, to wrap up this section before we've really started talking irrigation numbers at all, I think a summary of some key takeouts would be, maintaining a focus of costs of production's, careful balance. Management's the glue, and then seeking projects that have an appropriate level of return is a really important steering characteristic. And then ensuring that we dig deeper and think critically about what that project will bring us is really crucial.
Thanks, James. And it's really great to be able to see you step through that decision-making tree, if you like, about some of the things that you would be asking your clients to consider if they were considering investing in irrigation.
Absolutely.